Good day, folks. For my Canadian dividend-loving, focused investors out there, I did something that is a pure sin, and that is, of course, selling my Vanguard Canadian High Dividend Yield ETF out of my corporate account in favor of U.S. growth-focused investments, whether that's the S&P 500 or stocks like Tesla, Google. I'm going to be talking about all of that in this video, along with the next bull market that we are going to head into, which is going to offer rates of return you cannot imagine if you are not buying these dips right now. My God, people just don't understand what is coming as we sit in the eye of a storm related to inflation and interest rates. People keep telling me, oh, we're going to leave interest rates up forever. They're never going to come down. Look, you idiot. People are naturally greedy. People want economic growth. And the only way to achieve that is in a lower interest rate environment, because when interest rates are high, dragging down the entire economy, especially hitting small business and not allowing younger people to afford homes. I mean, it is a detriment to everything. Even home developers can't afford to build homes in this high interest rate environment, right? So this is only a tool to bring inflation down that was a completely self-inflicted wound caused by a once-in-a-lifetime crazy period, which was the pandemic. Man, take a look at this, because inflation during the last decade of like record low interest rates, the greatest growth period the market has ever experienced, there was no out-of-control inflation. Inflation hovered around 2% consistently. So what caused this massive influx of inflation? It was purely printing money. The Fed was absolutely terrified. The government, they were all worried that the whole economy came to a complete standstill and it was going to decimate any future economic growth. So what do? They printed more money than you could have ever imagined, and they handed it out, baby, like it was helicopter money just to anybody and everybody. And I took advantage of that in Canada. I completely lost my career. It did support me, but it led to this infliction of pure pain and inflation, because not only did people sit around and have nothing to do but spend that money, then they ended up going back out into the economy and just overloaded on products and goods, which led to insane supply constraints. And it just completely crushed the market and forced all these prices to rise in an insane manner. But this is a very cyclical thing. It is going to come to an inevitable end, as we are sitting in a time where people have record amounts of cash sitting in money market funds because they are favorable to the fear people think they're experiencing in the market. Yet earnings are starting to recover in most companies, and we're going to start seeing the end of this rate hike cycle. And then it's just a matter of when are they going to cut, and they will cut rates, and they will come back down to probably some fairly low levels. Is again, if inflation's under control, economic growth needs to happen, and that only really operates in a lower interest rate environment. I am telling you, this opportunity is only going to be here for a select window period of time. Like, listen to Tom Lee. I love this guy. He's been wrong a lot. He's been right a lot, but he offers some fairly clerical insight into my thinkings exactly.
Do you see this as a time to buy? And if so, why and what?
Well, there is going to be a time to buy between now and year end. I mean, you're describing it perfectly. We're in a period where fear is mounting. I mean, the VIX is capturing that. Investors are afraid to be in front of the freight train of higher rates. But at the same time, we know that the PMIs have bottomed. There's a ton of cash on the sidelines. You know, earnings are recovering, and the Fed is that much closer to sort of reaching the end of its tightening cycle. So to me, it's a formula that when the selling ends, and I wouldn't be able to tell you if we're at that turning point, but that recovery in markets could be very violent, higher, in the sense that the PE compression that we're seeing, I think, is excessive, and the pessimism is excessive. I mean, the economy actually is holding up really well. So I think investors should just remember the best opportunities to really make money have all come during periods of fear, whether that was March 2023 or it was October 2022. So yes, I think it still makes sense to be constructive, but it does feel terrible out there. You know, the long-term average of the 10-year is, I don't know, it's probably around 4.8. I mean, we're probably right there. So someone buys 10-year and says, I'll earn 4.8 or 5% forever. Well, the average S&P nominal return is 8%, and actually after a drawdown like this, it's probably 10% a year. So someone could invest their money today in the S&P and earn double the return over the next decade, or they can earn half of that owning a treasury bond. I mean, I know if someone thinks 5% is competitive with equities, it's not even competitive with the long-term return of stock. So, but if they're flat here at 4.8, since 1932, whenever you're at 4.8%, the average S&P PE is close to 19.5 times. I mean, there'd be multiple expansion coming, you know, in that range of yields. But if yields fall, then I think multiples go up. Of course, the TLT is a huge buy, but that would bring mortgage rates down. It would be a pretty big stimulus to the economy. So I think the only risk is if rates go to 7. I don't know if they're going to go to 7, but that is not what I expect.
There's no doubt about it that if you zoom out and you take a look at the broad perspective of every market from real estate to stocks, the higher interest rates have taken effect to some varying degrees, impacting certain micro aspects of each sector in its own way. But at the broad view, it is not catastrophic. We've actually survived this exceptionally well, and we just have to get to the other side of being out of the eye of this storm where we know they're going to start cutting rates. And in the next 6 to 8 months, as soon as the Fed is inclined to start cutting, that is when the market automatically starts pricing it in and we start going back into a new bull thesis, in my opinion. My speculative, clownish like YouTubers opinion, but I am putting my money where my mouth is. And obviously I've been talking about my corporate account a lot because I haven't been able to invest in my TFSA, not until the end of the year where I drew all that money out to buy a piece of real estate. So I'm praying to God this market stays suppressed for at least another 3 years. And as I mentioned in my chat group, thanks to all the patron supporters, that I did sell VDY on Monday. I actually took the position out of my corporate account as mentioned because my tax advisor said it's not great if you're not paying yourself out those dividends. You'll be taxed on 50% of those dividends. Like you'll be taxed at a 50% bracket on that passive income. And she said, are you looking to draw any money out? And I said, well, moving forward, not really, because I'm going to be focused on my TFSA and I'm not going to take that money and pay it out to myself where I'll be having to pay tax in my personal name, but I could avoid it by putting it in my RSP. But I don't want to focus on my RSP because I'd rather pay the tax on it and put it in my TFSA. But because I have a salaried position, it doesn't make sense to pull it out because it'll be in a higher tax bracket. And how do I avoid the 50%, passive income tax insanity? Well, I put it in growth stocks, and then sometime in the future, if I lose my salary position or I'm a lower income tax bracket, I can just take the money out, sell the stocks as I please at a capital gain, and then pay it out when it's more tax efficient. So I made that decision on Monday that I was going to be selling it, and now VDY is down about 1% since I sold. I took about 24,000 out of the position, and I completely converted it to US stocks. And I mentioned this, guys, last week when I told you that I was looking to basically start paying attention to growth-oriented companies like the S&P, like Tesla, like Google, though I think Tesla, Google are still rather expensive here. I'm not buying them yet. I'm looking for the window of opportunity. Hopefully Tesla drops on earnings as they may be less favorable, but I always feel they're very volatile and there'll be another window of opportunity to buy them when it makes a bit more sense. But in the meantime, I am loading up aggressively. I converted 20 of that 24,000, I took about 22, converted it all to US, not at the most favorable time, obviously, but I put half of that immediately, 10 grand roughly, into the S&P 500. And I know this isn't the most favorable time to be converting US dollar or Canadian dollars to USD because obviously the Canadian dollar is falling off a cliff as all these US investors are stacking cash, selling off their US assets, driving up the value of the US dollar. But honestly, I try not to predict where the US dollar is going. It's very impossible. A lot of people say, why don't you buy VFV instead? It's already the Canadian converted version and it looks like it performs better, but really there's no difference in buying either of these right now because if you bought VFV, it looks like you're only down 5%, but that's because it's auto converting the currency and you're still paying the US dollar difference. It's just if you convert the US dollar, even though the VOO is down 7.5%, if I sold VOO now and converted it, I'd still be gaining that 2% on the dollar difference. Honestly, these are pretty much the same. I just don't like that VFV has a slightly higher expense ratio, but honestly, it doesn't really make a difference what one of these you pick. I just like owning the native US dollar in my US investments. So that's kind of where I'm currently sitting. And obviously I'll be looking to buy again some of these tech companies when they become a bit more favorable, but nonetheless, I'm just sitting on my hands, just waiting till the end of the year, praying this window stays open for at least the next 3 to 5 months so I can just aggressively start buying in my TFSA while these rates of return into the future look juicier and juicier. If you're speculating that rates are going to come back down to a nominal level because people are greedy and the economic machine, the powerhouse that is the US markets, need to get back to the level they saw over the last decade. And I know every greedy person in politics, in the Federal Reserve, they know that's what they want. It's just getting there once inflation's under control. And I believe with my full amount of heart and attention that's what we're going to end up seeing. But that's just my humble opinion. As always, I'm a clown on the internet. What do you think in that comment section below?